Good afternoon, everyone, and welcome to this panel. We're going to be talking about bear market strategies, how to prepare for an economic downturn. So I'm Amy O'Brien. I'm FinTech correspondent at the Financial Times-backed publication Sifted, and we report on European startups. Joining me today are three excellent CFOs that are going to be sharing their own experiences at their respective companies, as well as their extremely valuable advice. So they are Julien Lafouge from Spendesk, Zhang from ClickUp, and Sergei Galperin from Allen. Now, I understand that this topic is kind of being shoehorned into a lot of other conversations today. I mean, why wouldn't it? So it's obviously the most important topic for CFOs right now. A CFO's role is taking center stage. So how do you plan most efficiently? How do you communicate those plans? And how do you avoid looking like the bad cop? These are all topics that we're going to be discussing today. So before we introduce the panelists properly, a little bit of housekeeping. I'm sure you're all full of questions. So we're going to have the Q&A tab open. If you just have any questions in there, you put them in there and people can upvote whichever questions you think are most resonant, and we'll try and get those heard. At the end, we're going to have a 15-minute Q&A session. So without further ado, I'm going to get each panelist to introduce themselves. So it'd be great to hear a little bit about each of your companies and your role within them. So Julien, do you want to introduce yourself first?
Sure. First, very happy to be here. Very interesting topic. I'll tell a bit more afterwards why I think it's interesting. So I joined Spendesk 4 months ago, so I'm fairly recent. I'm very lucky because we make a product and solutions, I mean, for whole organizations, but especially for the finance team. So it's really a privilege, and I'm very enthusiastic about my new role. Before that, I was CFO in tech at BlaBlaCar, for those who know it, carpooling platform, and at TMPG, which is a marketplace for real estate in emerging markets. And before that, so I started in finance, then did general management. I launched Brazil and Mexico, so Latin America for BlaBlaCar, and that's it. So you have good learnings both in tech and outside tech, but I'm very happy to be in tech these days. I guess about the period and team. It sounds depressing for many, but I think it's full of opportunities, and I tend to see. You have two categories of people, those who get depressed and those who see more, the glass half full and so on. I'm clearly in the second category, and I'll explain why. So I think it's a good opportunity for finance teams, CFOs to have real impact. I guess we had a rehearsal of all this during the COVID crisis, but it was kind of short. We don't know yet whether we'll have a real, recession, downturn, and so on. So we try to be optimistic and but kind of work with different scenarios, and we'll talk about it later.
Brilliant, thanks, Julien. Moving straight on to Dan then.
Hello, everyone. Really happy to be here. I am Zhang and currently SVP of Finance at ClickUp. So ClickUp is a productivity platform that helps teams collaborate better. ClickUp is that how we work nowadays is totally broken in this very complex world. People need to use 27 different tools to talk to their teammates, keep each other updated and accountable in this remote world. So to solve that problem, we built ClickUp to help people keep track of their work and work in only one platform. I have a little bit of an unusual starting point of my career. I like to divide my career into 3 chapters so far. Chapter 1 was journalism. My education route was in sociology. So I spent some time of my adult life covering social news in China. So journalism has a very broad reach, but people watch news and forget about news very quickly. I wanted a very deeper impact. So I believe that business world is where people build dreams, shape lives, and have a larger impact. So that's my chapter 2, was I came to the United States to study business. I did my tour of duty in corporate finance at 2 public companies, Amazon and Expedia, where they have very, very strong finance practices. at these two places, I got to work with the world-class finance executives and seeing the best practices in FP&A. It was really great training ground for me, and that led me to my chapter 3 of the career. Was I found my ICP, the ideal customer profile company, which was the startup companies doing its hockey stick phase that needed a scrappy finance leader to build the finance and operation and business foundation, that also seeing the scale and know what great looks like. So I was part of the 3.7 billion Cisco acquisition of AppDynamics. My previous company, People AI, was also valued over 1 billion as an enterprise software startup. Because of I think the diversity of my background, I approach finance from a standpoint of storytelling on context building. And I lean towards understanding business as a whole, because I believe that if you understand the business well, you would understand the finance of the business very well. You would also understand how to influence a decision to optimize the value of the business well. To me, that is the biggest value of the CFO during the bear market and as a wartime CFO.
Super interesting, Dan. Your career path is inspiring me. There we go. Okay, Sergei, let's hear a bit about you and your background.
Cool. Thanks, Amy. Nice to see everyone. And thanks for joining. I'm Sergei, CFO of Allen. Allen is a one-stop health partner in France, Belgium, and Spain. No, that's a lot of buzzwords. What does that actually mean? We launched in 2016. We were the first company in France of any kind to get an insurance license since 1986. So we started out as a health insurer. And we kind of have, as Dan had 3 career chapters, our life at Allen has 3 kind of eras that we say. Allen 1.0 was from 2016 to 2019, where we were focused on the startup world in France and the tech world in France and offering their employees health insurance. The era 2 at Allen was from 2019 to 2020, where we really branched out into other verticals and really became a major player in the health insurance industry in France. And the third era is what we started in mid-2020, kind of unintentionally, but coinciding with the COVID pandemic, where the company grew from being a health insurer to really this one-stop health partner, where we don't just show up after someone needs reimbursement for treatment. We are there through a person's or a patient's entire treatment journey, from pre-care information to avoidance to information to finding a doctor to then getting the treatment to then getting reimbursed for the treatment and getting post-care support. We've also expanded into Belgium and Spain. Before that, I was a banker at JP Morgan in London for 15 years, the last 5 of which I started and built JP Morgan's fintech advisory practice, and then saw the light and decided that being on this side of the industry would be much more fun. And I've been at Allen for 2 years, and it's true, it's much more fun.
Brilliant. Thanks, everyone. So we've got a real range of experience here and also different sectors, which I think is going to be super interesting. So we're all addressing the same economic climate. Obviously, reporting at Sifted, I'm coming across a lot of these like high-profile business model rethinks at the moment or in the past few months. These have included layoffs, etc. But it's my understanding that CFOs, you've been planning for a market like this for a while. That's part of your job. So I'm quite interested in asking, perhaps, let's start with Julien. Like, how long, obviously you came in mid-year, so I think it's quite interesting to first off, speak a little bit about coming in during this 2022 market and how much had been sort of prepped before you, how much were you inheriting from your previous CFO, and how have you had to shape the strategy coming in now?
Right, thanks for that. So first, I'm lucky in at least 2 ways. One is I inherited a really great team, so it was all in order, and we therefore I could focus directly, on the issues at hand, and being a business partner, etc. And so lucky in that sense. Second is that so Spendesk, we offer what we call a kind of all-in-one solution for spend management, right? So it's really what you can call a recession-proof, product. So basically, we keep growing like crazy, and our questions are more like, how do we support the growth as a finance team and so on, rather than panic or whatever. So it's not, not at all the mood. We support the growth. Our product basically enables finance teams to have better visibility, better control over, the finance, of the company and the spend in general, be it invoices, expense reports, whatever. We basically enable companies to get rid of expense reports, which has value per se, because nobody wants or likes to do that. So that's the context. So that's a bit of an outlier. Now, if we take a step back and put it in the more general context, I guess some companies will suffer more than others, and I should talk about my previous experience, whereby all of a sudden COVID hit and the turnover went to zero because we couldn't operate. It was just forbidden by the government everywhere we were. And so it's a very different kind of situation and reaction and etc. But still, there was no panic. We just made the right scenarios, planned. I think we're going to talk about it, but being well capitalized is fundamental. Just read a study mentioning that in France, startups are actually, and it was very surprising. I'm keeping a bit of the suspense, but basically startups with less than 1 year runway, it's 62%. So, 1 year runway, when a crisis hits, it's nothing. It's just, the time to kind of go to market and pitch your story, but it's very difficult. So I'm lucky in the sense as well that Spendesk is well capitalized. I had, the founder and the team had foresight, and they were ready to continue growing in whatever environment.
Got it. And like Sergei, I remember that in our briefing call, you mentioned that your investors have sort of been encouraging you to prepare for wartime for a while. So talking about being well capitalized, I'm super interested in what that entails and what that entails for managing your runway, Alan.
Sure. Thanks for the soft toss, Amy. I remember when I was in banking, times were great for the past 5 years, and companies were getting to this cadence of, we'll just raise every year. We'll raise exactly this 1 year of runway that Julien was saying, because times are good. We'll raise a little bit, grow a bit more. Our valuation will go up. We'll raise a bit more, etc. And I always thought that was probably dangerous. It's kind of like driving down the highway with a knife sticking out of the steering wheel instead of an airbag. You just slam on the brakes. You don't want to get hurt. So when I joined Alan, one of the things that we wanted to focus on, or I was really keen on focusing on, is actually extending our runway and raising a bit more so we have more runway. So when we raised our Series D in April 2021, that gave us 18 to 24 months of runway, not just a year. And then when we were approaching the end of last year, we had about 1 year of runway left because we raised 6 months earlier. And we were thinking of when we should raise. We thought, okay, maybe we'll raise in 6 months. And to the point about investors, we've been really, really thoughtful about how we build our cap table. And we've been really, really protective of who we let into our cap table, because we want to get advice from the people that share our vision and people that we trust. And one of our investors, who has been absolutely incredible, they've been telling us that they've predicted 7 of the past 2 recessions, and they're saying they've seen this all before. And don't wait till May 2022. This is in November 21. Go now, go right now, drop everything else, raise right now. And in the end, it was actually the best advice, because it allowed us to prepare very thoughtfully for what we wanted to do next, go with a very strong story, and raise from a position of strength. So it's easy to say, oh, we saw this crisis coming. We saw it a little bit. We were advised correctly, and we listened to good advice. So we started fundraising in January. And again, it wasn't in January to fundraise just for the year ahead. We raised for 3 years of runway, and hopefully actually we'll never have to raise again. So that was how we approached it.
Very, very fortunate position to be in, but obviously through your own doing. Dan, then tell me a bit about whether you were clear that this was coming, and also, I guess, did you plan at all for a scenario where you did run out of funding, and what would happen there?
Yeah, we were the lucky batch that we raised our Series C of 400 million in September 2021. So that at that time we even got the advice from the investor community that, hey, ClickUp, don't raise that much of the money. Take 100 million, take 200 million, and raise at a higher valuation a year later. Right. So that was a typical bull market thinking. We used to joke in the CFO group, it was ARR, is annual recurring raising. And we decided to take more money. We take the entire 400 million because Zeb, our founder CEO, and I were concerned that the party would stop, given how irrational the market was. And we did not want to worry about fundraising constantly. It could be a big distraction to our operations and the focus of building the product that the customer love. And we can, this is how we convince each other. We said no company has ever regretted taking more money. In reflection, they always regretted not taking enough money when there's money in the market. So we took it, we're good. The only concern as a CFO in the company in the back of my mind was raising the money you don't need will become the spend you don't want. Right? It would be really challenging to instill the operating discipline, the spend discipline when money is cheap and people can just turn around and raise another 100 million. And then the market turned. I was not concerned anymore because this money became the true winter fund that will get us through the economic downturn and will get us all the way to the IPO in 3 years without raising any extra round. So the message from our investors was crystal clear since the end of last year: extend your runway and shift towards efficiency. David Sachs was our board member, and he was very insightful and supportive, constantly reminding us that, hey, rest in peace, good times. This is season 2 now. 3 most important things last year was growth, growth, growth. And 3 most important things this year is growth, your gross margin, and your burn multiple. So whoever moves fast and shifting their mindset will have a higher chance to survive. We very urgently revised our plan several times, I would say 10 times, slashing non-revenue generating and non-essential spend very aggressively to get to that cash flow positive scenario. So cash flow positive is what YC used to call the default alive. So we quickly get a very large venture loan lined up as well. So with a financial plan that leads us to cash flow positive, default alive, and a large venture debt as an insurance plan, we are very well prepared for the winter that's coming.
And Dan, you said something really, really great that I totally agree with. I think people underestimate how distracting annual fundraisers are. It really takes management, the CEO, the CFO, the CPO, the CTO, the co-founders. You know, it could be a 2, 3, 4 month process. Out of a 12-month year, it's really, really distracting. And the fact that raising a bit too much, quote unquote, and then being able to focus for 2 to 3 years just on execution rather than focusing on building, rather than talking about what you're going to build, has just been a breath of fresh air. And really, what we see within Alan really accelerating our ability to deliver.
Absolutely. Yeah.
On that, actually, I'm assuming that sort of during the fundraising process, for example, like do you feel less connected to the CEO because they're sort of out doing all of that and you're having to scenario plan for all these different things? I don't know, Sergei or Dan, do you want to take that question?
No, I actually, for me personally, maybe it's my background before JP Morgan, but actually, and also us as a company, the fundraising were a big bonding experience with the CEO. You're kind of in the trenches together and sharing ideas of what to do next. And to be really honest, I think fundraising exercises are all about psychology. It's how do you find the right investor to kind of choose you? You have the list of investors that you wish to invest in you, but you also want them to want to invest in you. So it's kind of like this mating dance, and It was a great bonding experience of just not talking about the business, but talking about the psychology of how do we convince people to believe in our story as much as we do.
And I was also super interested in how you've approached these cuts. Dan, you mentioned like identifying the different aspects that are cost, running through the burn rate the highest. So how have you identified those? Is it in terms of like the different tools that your company use? What areas of the business? And how did you go about making those cuts in a way that the whole organization understands?
Yeah, when we talk about cutting, because that's the dirty word in the company, right? Everyone just got this knee-jerk reaction when they hear cutting. I think as a finance leader, it's very critical that we build the right narrative, right? To bring people along. So first, that I think you need to have a financial model that really identifies the diminishing return points of the investment that will elevate the entire planning conversation you can have with your board members, with your CEO. So we basically carved out our total sales and marketing spend in tranches and stack rank them in the ROI, in terms of ROI. So that allows us to have the very broad conversation about our planning scenario. Do you want to grow 120% and burn all the money in 2.5 years, 2 years from now? Or do you want to grow 80% but get to the cash flow positive? So those are the right questions you can ask and get people to take a step back. We're cutting because that we want to extend our runway. We want to get higher valuation. We want to get a good term. Right? So secondly, identifying the key spend levers that get to the default alive in all three case scenarios, right? The bear market, base, and bull case. Go for the big cuts and being really, really cautious on the morale impact of the small cuts. Right? So for example, we cut the big budget for an in-person company kickoff that we used to plan for this year. But we didn't touch our T&E budget, the travel and entertainment budget. So T&E is those type of money that has a large morale impact, but you don't actually save big bucks on cutting it. Right? So those are some of the kind of the learning and tips we got from cutting the cost and get everyone onto the default alive plan.
Really, really interesting. And I guess like taking a bit of a step back actually from pre-cuts, I'm still quite interested in discussing a little bit more around scenario planning and everyone's approaches to that. So Julien, I'd be really interested to hear sort of how much is too much with scenario planning and where, how do you find that balance so that everything is prepared for?
Yeah, learned a lot. Thanks for the question. Learned a lot during the COVID crisis because I think it showed all of us that as good as we thought we could be, we never made the right scenarios, which in my case was basically turnover going to zero from one day to another. I never did that scenario before COVID, right? So you don't really stress test. You think you're, stress testing, but you're not. You're just doing, okay, plus 20%, minus 20%, what happens, and life is good, and so on. And so actually, once it hit, it just, you have to question yourself and you make scenarios much, much wider in terms of hypotheses and potential outcomes, which is a good thing. So then we played with, the duration of the crisis, how long could we sustain zero revenue, because there was too much unknown. And today, I guess, it's the same. There's a lot of uncertainty. Everybody has an opinion. In fact, nobody is right or wrong because it's about the future. So, if we knew the future, we would all be rich. But basically, you've got to make scenarios with an amplitude, I would say, that's sufficient to really stress test. And on the positive side, because stress test has a negative kind of connotation, but on the positive side as well, being able to profit from the rebound. Rebounds are usually quite brisk and quick. And if you're not ready and you've cut too much, you've cut the muscle, then you don't benefit from that. Your competitors get ahead of you and you miss a huge opportunity. So you never cut the muscle. On the other hand, and I can relate to what Dan or Sergei were saying. Yes, you have to be realistic, and you always, when you innovate, you try new things. Some don't work, and you have to cut them to zero. It's not about let's do plus 10% and see what it gives. Sometimes you have to face the fact that this thing doesn't work. Let's use the money differently, or let's save it and go faster to profitability. So yeah, that's it. Make scenarios quite extreme, even if it triggers some difficult debates inside.
I'm quite interested in there and sort of the kind of positive view of seeing this as an opportunity, because I mean, fundamentally, it's probably the best thing to do is approach this with positivity. But I don't know, Dan, do you want to talk a little bit about sort of opportunities, especially I'm thinking with like talent and employee happiness and things like this? How do you make sure your employees like stay in the game and you're bringing people in, even though you're dealing with like a really tricky economic environment?
Yeah, talent retention is the top of mind for me and for my leaders at the startup company. So we were really doubling down on the talent retention, because we already see that the Great Resignation proves that losing top talent to a larger and stabler business is the #1 issue that can hurt the startup business really, really badly during the downturn. And we launched a survey to ask the people, hey, what keeps you here? Why do you wake up every day, still want to work for a startup company like ClickUp? And we found out that the #1 reason of them staying here at the startup is not about the money, it's not about the valuation, it's about learning and growing here. And there are 2 big factors that retaining the top performer in the bear market is: first, do I have a manager that cares about me and help me grow? Second is there true opportunities in the company that I can practice the skill sets we learn and help me grow? So me and my leaders in finance, we took the bear market reality as a rally cry to motivate the finance team. So we like to say that never waste a crisis, because steady C never made the skill sellers. Right? The last generation of iconic company were really built during the financial crisis, and a lot of financial professionals that got the front seats of how to guide and steer the business during the very complex time, they grow to be the wartime CFOs. Really kind of inspired the team to tune out the noise in the market and very faithfully, in a very focused way, executing our business plan and focused on building a long-lasting, evergreen business is the best guidance as a CFO you can give to your team and give to your entire company.
Super, super interesting. And I guess that brings back to this sort of collaboration question and how you bring everyone together with you in the belief that you're going to get through this, but you've got to make these like tricky decisions in the short term. Sergei, I guess it would be really interesting to ask, what do you think the key skill is there with bringing the other business leaders along with you? Especially, I'm thinking of people that have, worked in startups post 2016, have never seen a market like this, and you don't want to always be the bad cop, just bringing the bad news. So, interesting what you'd say.
I think it starts with the filtering and the recruitment of the senior leaders. At Allen, we have a mantra that we shamelessly stole from Amazon, and it's that we hire missionaries and not mercenaries. And missionaries, not the religious kind, but the missionaries that actually believe in your mission and are there to really pull on the same end of the rope and to really drag and push and pull the company towards your goal. And I think when you have a lot of mercenaries, they jump ship or they abandon ship at the first sign of trouble because they'll just go to the next highest bidder. When you have missionaries that are really, really focused, like for Allen, on one-stop health partner, what are we doing today to approach that mission? Whether the public markets are down, whether they're up, whether we're growing 100% or 30%, are we taking the next step down that mission? And we start with the filtering of senior Alleners, and all Alleners, are they missionaries or mercenaries? And we try and only have missionaries. And secondly, it is what we do actually internally, and what I do spend a lot of time on. It's kind of like financial education. It's This is why we are raising prices by 10%, because it will mean that our margin will go up from X to Y. And that means our gross profit does this. Therefore, we can afford to hire 10, 15, 20 more people. Those 20 more people can build this feature, which will deliver this. And then this is our path to profitability. And when we produce our monthly financial results, I actually recorded a 3-minute Loom video that actually goes through our monthly results, and we post it for the whole company so the whole company can see this is how we performed this month. This is what went well. This is what did not go well. This is how we're progressing towards a path to profitability. And I think it's that sense of transparency, that sense of aligned mission, that sense of ownership keeps everyone together. Now we're 500 people. Maybe if we were 10,000, it'd be harder to keep cohesion. But so far, with radical transparency and with missionaries and so far it's been working, keeping everyone together.
Really, really interesting, and especially, you know, I've been looking at lots of the communications within companies, internal comms around rethinking business plans, and there's certainly good examples and bad examples. So good to hear that this is a top priority. I think it'd be really good. We've got so many questions coming in, and they're all really juicy. So I think I'm just going to go straight to some of the questions on here, and we'll see who's most appropriate to answer each of these. One of these is screaming out for Dan to answer. Why did you take on venture debt additionally to your huge Series C?
This is the CFO kind of voice that I have in the back of my head, is having an insurance plan, right? Although we have the bear case and base case, this is taking a large venture debt is really to plan for that doomsday case, right? So by doomsday, we're talking about instead of growing 70%, 80% as a hyper growth startup, growing 10% of your top line and losing 60% of your customer install base. That is a doomsday case. I think very, very few finance leader is actually planning for that. But if that hits, that black swan event actually happens, I need to have like a double safety net. So that is being a very, I think really the hope for the best and plan for the worst. That whatever insurance plan, whatever safety net you can bring to your company as the CFO who's playing the defense in this tough time is really critical.
Cash is king.
Cash is queen.
Cash is king.
I feel like we could actually compile a little book of like CFO dictums from this panel. Okay, we've got quite a specific question here, but it might be quite fun to ask. I don't know, Sergei or Julien, if you want to take this. It's taking into account our challenging macroeconomics. What do you think the role of digital marketing is in securing cost efficiency and a healthy pipeline to sustain growth?
So I was in marketing before because I was general manager and basically, you know, BlaBlaCar relies on marketing and not sales to grow. The beauty of digital marketing is that you can measure things, so it's kind of reassuring. You're not like, okay, I'm spending, but I don't really know the return. On the other hand, if you read a bit more, and Scott Galloway has really good pieces on it, the problem with that kind of marketing is that it becomes an addiction and you don't do marketing anymore. You're doing paid advertising online, and the numbers are skewed, not always as accurate, and the ROI. So I won't enter into that, but to me, it's the good thing about it is that it's reassuring. You can put limits and work on your unit economics. As we said, I think we all agree, it's not because you're growing that you don't want to show good unit economics. On the contrary, I think it's always the case. In good and bad times, unit economics should rule. It's just after cash, but it's a huge enabler for cash. And so, yes, marketing is a huge contributor to the, let's say, health of unit economics or the not so healthy unit economics. So it's not that, you know, as I said, there are things that if they don't work, channels or whatever, you cut 100%. There's no like fine tuning or whatever, but you should double down on what really works and has good unit economics, because in any pitch, if you want to, raise in the coming months or whatever, it's not just about the top line growth anymore. As Dan said, before it was 3 metrics, growth, and now it's a bit different. So you've got to see, cash returns and so on. So you have to be very careful on that marketing aspect. Yes, it's looked at very carefully by investors.
I think it also depends what kind of business model you have as a company. Are you B2C? Are you direct to consumer? Are you B2B? And at what stage you are. I think maybe startups sometimes jump into digital marketing far too quickly without understanding if they have product market fit. And I think a lot of companies should start with word of mouth. Does your product actually have traction? Can you get true fans that love you and that will market you for free, or do you have to pay for clicks? I'm far from an expert, but also my understanding from spending a lot of time with our marketing team, with the changes to ATT, which is advertising tracking technology with Apple and Google, my understanding is that actually advertising that B2C companies have been doing for the past 3 to 4 years has become a lot less effective recently. So it's kind of back to the drawing board of how do companies use digital marketing going forward.
Amazing. That was the exact question I was going to ask you, B2B versus B2C, because obviously we've got a combo of companies here. Okay, I'm looking at the other questions. I guess, okay, this is really interesting on the employee side of things. We've been speaking about keeping everyone in the game. Someone's asking, as a CFO, would you come up with the idea of supporting your employees through inflation by giving them an unplanned bonus, which was not planned while budgeting? Is this something that seems appropriate right now and a tool for keeping people in the game? Or, as you were saying earlier, are the missionaries going to stick around come what may? Maybe Dan, would you like to answer this one?
I've seen a large variety of the creative offering that the company has been able to provide to their employees. So for example, in some of the startups that they offer the choice to the employees, hey, you can trade 10,000 of your base salary to 50K or 100K of the options. Or if you really optimize for cash at this point, then you can swap some of your equity with cash, right? So give that window to the employees, because people want different things at different stages of life. So you don't know all the scenarios, all this kind of different things happening, that why do they need more cash? Why do they need more equity at this point? Because sometimes people want to double down on the equity part during the downtime. So giving this option and really put your creative mind together as a leadership team, it really matters. And this really shows the how flexible and you can be to your employee base. So this is a very high ROI activity for the leadership team to really reach out to the employees and say, hey, we know that time is tough, and here are the options that we're creating for you. And some other tips that there are companies out there now, a very creative fintech company, they offer things like you can take a loan or you can take some cash without actually selling your options. Right, so the companies will take some of the upside from the options when it becomes liquid once you kind of go out and be public. But unlike the secondary that they actually buy your options, but the employees lose all the upside when we go public, you actually can take a loan from it and then give 10%, 20% of the upside to this company as part of the new financial product offering. So there are a lot of options out there that I think as a CFO, you could go out and really see what are the most appropriate kind of investment or tools that to your own employee base.
That's super interesting. And I guess, Sergei, going back to your point of like the financial education point within the company, with options like this, when you're getting a little bit more creative, how do you communicate like what that actually means to employees to make sure that they're making the best decisions for themselves and understanding what you're offering them?
Yeah, so great point. And Europe tends to be behind the US in terms of stock options and employees valuing or understanding the value of stock options. And being based in France, I would actually say France is behind the UK in seeing and understanding the value of stock options. So indeed, when I joined, a lot of education spent explaining to existing employees and new recruits of what is the stock options that you have. So we actually, as part of our Allen.home portal, like employee portal, we built a little options like sandbox where we explain these are the options you have. This is your vesting schedule. So as the months tick by, this is how many options you now have. This is our current Series E valuation. If you were to sell now, this is how much you would get. And then you can fill in what you're worth in the future and what you would get. So it's to kind of demystify the actual numbers so people see plain as day. Is it $100? Is it $100,000? Or is it $1 million? Because people just don't know. And the second thing that we've been really keen on is allowing some secondary, so employees actually see that, hey, this is not just something on a screen. This is really tangible. So we have policies in place where if you've been with us for at least 2 years, you can sell at least 7.5% of your vested shares. And if you've left us, you can get rid of you can sell all of your shares. And it's good for existing employees. It's good for new employees to see that people have been able to cash out. And we also think it's good for the ecosystem just to show that, hey, options are a real thing. And the more startups are generous with them, the more people value them, the more it becomes a relevant part of the compensation package.
Super interesting. We're always reporting on this at Sifted. I'm very, very fascinated by it. Okay, moving on to another question that's a little bit more nitty-gritty. Okay, it's a long one, but I think the crux of this question is, let's talk a little bit more about the types of cuts that we're talking about making, small cuts versus big cuts. And they say they agree that when you do big cuts, you're cutting the muscles and opportunities. But what actually are the sort of first lines of defense when you're making cuts? Like potentially, let's talk about what kind of investments go first or are most, I don't want to say disposable, but most at risk. Julien, do you want to start this one off?
Yeah, so maybe splitting in two categories. So you have the payroll and the external costs, let's say. So external costs first. I guess we all like Excel in this community, and there's a beautiful function that you can rank in an order. So it's 80-20. You'll have thousands of lines of spend, but you should focus on the probably 20, 50, 100 that really represent the bulk of it. And sometimes, you think, oh, it's fixed cost because it's, I don't know, it's my offices and I have a very stringent contract, but everything is negotiable. In fact, you can go back to it and you should question everything. There's no taboo. Most important is no taboo. Now, the typical kinds of costs you don't want to cut is the good quality coffee for your employees, because it has no impact financially, but it has a terrible impact on morale and so on. It's just the stupidest thing, or that kind of stuff, right? It's frustrating. It brings morale down, and it has no finance. I mean, if you're at this stage, and it means you should have done all the big things before, and you're kind of really desperate, right? So I think it's a question of common sense and always judging, okay, not just the euros, but also the soft aspects, the intangible of morale and do people want to work here? Sometimes you don't need an extra bonus, but you just need to maintain the good benefits that you had in place and have interesting projects and some optimism, whatever the situation is, and look to the future. So that's my 2 cents. Then on the inside, like the kind of payroll cost, it's always easier when you grow, because the game is just to grow your payroll less quickly than your top line, and then it's kind of not painful. Then you have levers, or it's about what's fixed, what's not fixed, what do you insource, what do you outsource. So if everything is kind of fixed and you don't outsource anything, obviously you have less flexibility. So in the past, at least, we always try to build like, okay, what do we really need to do internally and hire people for versus we use an agency, that kind of stuff. So it should be questioned during these periods, because if you realize you have a kind of a very heavy fixed cost structure, okay, let's introduce some flexibility in it.
And one thing I would add there is cutting is that kind of the dirty word in the corporate. And there's another word that also gives the same reaction to the leader is the freezing spend. That can also cause the micro fatigues and micro frustrations. As finance leaders, that we really need to welcome the other leaders in building the budget framework with us, so they feel that that they are empowered and they have the full control to optimize their performance. Because the sales leader have a quota to hit, right? Marketing leader have a pipeline target to hit, and engineering leader have product roadmap to hit. So for example, like in ClickUp, we set the milestones to release additional headcount. Right, so what we call is a conditional hiring. Yes, we're still hiring, but we start to put more checking point and guardrail. For example, marketing. I put a 12-month of the CAC payback as a guardrail to our marketing spend. As long as you can hit your 12-month payback, you can continue to invest in, because that's basically net positive. It's bringing the profit into the company. Sales hire, that we draw the hard line for our sales team. You can only add more sales headcount if your existing sales team is achieving over 90%, right? So you seize your own destiny in your hand. Come to me and say, hey, I hit 100%. I want to hire more reps. Go ahead, right? I'm not the inspector. I'm the enabler. So kind of building that framework with your business leadership team, so they don't feel like it's finance constantly hammering them down. They feel like, okay, it's up to me to really prove higher ROI in order to consume like more resources. Just want to add that one point there.
Super, super interesting. So I guess it's going to be a surprise. You don't want anything to be a surprise. I guess that's the key takeaway. Guys, thank you so much for sharing your insights today. I hope it's been useful to everyone in the audience. It's certainly been fascinating for me. And I hope you enjoyed discussing all your different approaches, and good luck to everybody. I'm sure that times will get better eventually. Thanks very much, everyone, for joining. Great.
Yeah.
Thank you.
Thanks, everyone. It was fun.
Bye.
Bye.
Bye.